Did you know that, based on her extensive research and experience, investor Cathie Wood has issued a dire warning regarding the financial industry? Wood said some really insightful things, and you wouldn't want to miss them. We think there has been a policy error made by the Fed. The Fed should take a moment to consider the various catalysts that we are seeing, according to Cathie Wood. It should lead to a complete policy shift and reversal, if not a stop. The markets are alerting us to the fact that they are making a mistake, which they are. If they continue to follow the CPI, a lagging indicator, I believe something will go wrong that affects them. The founder, CEO, and CIO of ARK Invest, an investment firm with $60 billion in assets that makes bets on cutting-edge technologies like genomics and self-driving cars, is Cathie Wood, an American investor and celebrity stock picker. Because of her ability to persuade others with her investing arguments and her track record of success supporting her surprisingly astute claims, Cathie Wood is frequently referred to as the most underappreciated investor in the game. Cathie Wood offers monthly updates on a variety of topics, including innovations, expectations in her area of expertise, monetary and economic policy, and her thoughts on Fed decisions. The United States Central Bank, the Federal Reserve System, or Fed for short, is in charge of overseeing the country's financial and monetary systems. The Federal Reserve increased interest rates in June by 75 basis points to 1.5 to 1.75%. This was the largest one-time increase since 1994. It is anticipated to hike rates by an additional 75 basis points later in July. The likelihood of that happening is priced at 90.6% by one CME FedWatch tool. Wood would contend that the Fed should be concerned about deflationary forces and believes that this action was a mistake. There are all kinds of deflationary signals which are going to force the Fed, we think, to pivot and reverse its policy, said Wood. Deflationary signs include movements in gold, the U.S. currency, oil, copper, yield builds, and trading patterns. Gold, which is sometimes seen as an inflation hedge, has dropped below the $1,723 per ounce mark over the last few months, losing about 12% of its value. Wood noted that this trading pattern contradicts the theory of inflation. Cathie Wood warned that the United States is already in a recession in late June. In an interview with CNBC, Cathie Wood, the CEO of ARK Invest, acknowledged that she had misjudged the level of inflation and went on to suggest that the U.S. economy is probably now in a recession. Wood attributed the increased price pressures beyond her initial projections to supply chain interruptions and geopolitical concerns, such as the conflict in Ukraine. She added that a recession had already started, mostly due to poorly managed inventory. "We believe we are in a recession," Wood stated in an interview with CNBC's Andrew Ross Orkin. "We believe that inventories, whose growth I've never seen this significant in my time, are a major issue. I have 45 years of experience." The investor who prioritizes innovation claimed that supply chain disruptions and geopolitical concerns are to blame for the unexpectedly high rate of inflation. Major shops mismanaged their inventories due to supply chain concerns, Wood explained, which resulted in an excess of some finished goods like furniture that were in high demand during the epidemic. She claimed that issues still plague even the world's most well-run businesses. She continued by saying that in her 45-year career, she has never seen a spike in inventories like the one that has occurred during the last year. Wood maintains that inflation is still a transient issue. This becomes clear when investors start paying closer attention to how gold, the US dollar, and yields have been trading, Wood stated. Wood stated at the beginning of July that gold had broken down to the lowest point in its range and has been one of the most accurate indicators of inflation. That will confirm, in my mind, that deflation is the greater risk here, not inflation, Wood said. She continued, pointing out that the US dollar index is trading at 20-year highs, and that the recent dollar strength is an even stronger indicator of deflation when discussing gold prices. In addition, the 10-year Treasury yield remains around 3%, while the price of oil has dropped by roughly 20% this month. Despite the events in Russia, even oil is beginning to falter due to the global economic downturn. As a result, demand has not increased over 2019 levels. Rather, supply has been negatively impacted. As of right now, oil is down 22% month over month at $96, she noted. Another example is copper, which is used as a barometer of inflation and actual activity. According to Wood, all of these indicators suggest that the inflation issue is exaggerated. If we are right and inflation unwinds pretty dramatically during the next 6 months, that should help growth, Wood stated. We were strong on one thing, and that was inflation being as sustained as it has been, Wood stated. It's unbelievable that Russia's invasion of Ukraine has taken more than 2 years to complete the supply chain. Naturally, we could have seen that inflation was a more significant issue, but it has made deflation more likely. To put it more simply, a recession is a contraction of the business cycle that occurs when there is a broad downturn in economic activity. It is a brief period of decreased trade and industrial activity that is typically indicated by a dip in GDP over the course of 2 quarters. Recessions typically result from a sharp decline in consumer spending. The rate of price growth during a specified time period is known as inflation. Usually, inflation is measured broadly, such as the total increase in prices or the rising cost of living in a nation. Conversely, when the inflation rate drops below 0%, there is a decline in the overall level of prices for goods and services, which is known as deflation. Over time, inflation lowers the value of money, but abrupt deflation raises it. We know that innovation in the public equity markets, not the private equity markets, has been ravaged in the last year, Wood stated in a recent interview. It has been devastated for about a year now. Rawls stated that last year, despite the shift in expectations, inflation increased but remained controlled. The previous year, there was a belief that the economy would expand and interest rates would rise. The problems with the supply chain persisted. Nevertheless, Wood stated that while initially affecting the innovation area, the concern about the potential effects of inflation and interest rates is now appearing to be affecting the market more widely. I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we've seen inventories piling up throughout the ecosystem, Wood said. Wood claims that the share of innovative stocks in public equity markets has decreased from 75% to 50% during the past year. The founder of ARK Investment Management, Cathie Wood, believes that the recession in the United States may have already ended and that it may end in the upcoming year, despite concerns expressed by other investors. Many strategists and economists disagree that we are in a recession and believe that the United States may have one in the upcoming year. In fact, we anticipate emerging from it in 2023, Wood stated. Professor Jeremy Siegel of the Wharton School of Business concurs with Wood that the United States is currently experiencing a recession. Siegel stated to CNBC that the first half of the year's economy most certainly shrank. I think we're actually in a mild recession, he stated. According to him, the signs he is keeping an eye on suggest that the economy would slow down in the third quarter. He specifically mentioned data showing the fall in the U.S. money supply, which suggests we are beginning to control inflation. According to Wood, there are numerous signs that prices are beginning to decline, and she believes that the inflation that has everyone concerned is not the correct way to view the world at this time. She underlined their conviction that the greater risk is deflation. We believe that deflation is a much bigger risk, Wood states. She continued by noting that they have been making this claim for some time, during which they have faced c.